Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, bear markets are typically defined as a 20% decline from the most recent market or index highs. Last week, the S&P dipped in and out of bear market territory. As a matter of fact, the Dow posted its 8th straight loss in a row. The S&P dropped 7 straight weeks, and the NASDAQ declined more than it did during the COVID crisis. What do you think the markets are telling us?
Well, Steve, investors seem to think the U.S. economy is headed towards a recession. Inflation remains sky high at 8.3%, and that's forcing the Fed to pump the economic brakes, with higher interest rates and reducing liquidity to markets. The war in Ukraine isn't helping matters currently, and retailers like Walmart and Target reported poor results, noting that inflation is taking a bite and needs to be tamed.
So Travis, experiencing a bear market is painful, but they come in all shapes and sizes as shown on the chart on your screen. Some are as short as a month, and we lived through that during 2020.
Yes, we did.
And others can drag out over a long period of time, 30 months or more. On average, the decline in a bear market, though, is around 36%, and that happens typically over a time frame of about 14 months.
Yes, Steve, and that's the average, but just as you pointed out, all bear markets are different. Deutsche Bank actually has a somewhat brighter view. Recently, they noted they see few hallmarks of a recession. The employment picture is strong. The U.S. economy's added 400,000 jobs for 12 straight months. Plus, the Walmart and Target poor results that we talked about earlier are noted. They think that's due to operational blunders versus, the economy. They stocked up too much on inventory, which they subsequently had to mark down, and they overstaffed, not anticipating how many people were going to come back to work after COVID receded. As a matter of fact, Bank of America, Visa, JP Morgan, all are reporting strong consumer spending and strong balance sheets right now.
Yeah, Travis, a market drawdown likely helps the Fed here battle inflation, though, doesn't it?
It can, because falling markets can reduce consumer sentiment. You don't feel as wealthy. You don't spend as much, and that will slow, economic growth, and that could help blunt inflation, drawing it closer to that 2% Fed target over time.
Good luck.
Although I don't see 2% anytime in the near future, but if you're a net buyer of stocks over time, we like lower prices. Having money to deploy during market drawdowns is going to help future returns over time.
For sure.
That doesn't mean we've hit the bottom yet. It doesn't mean that we're just going to rally straight out from here. It simply means stocks are cheaper than they were at the beginning of the year, and if you're a net buyer, we like to buy at lower prices.
That's true, Travis. It's been great. I look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.